I want to move on to premium timing, which you've done a bunch of really good work on. Can you talk about why timing exposure to premiums is so tempting?
Why? Well, there is a lot of economic incentive for doing so, right? It's also not our first time to look at premium timing. So basically, if you can figure out precisely right when to go in and when to get out, that's phenomenal returns. So actually, just before this, I took a quick look at just S&P 500 return, say from 1926 to end of last year. Your $1 will grow to $15,000. That's pretty good. That's 10% annualized. But then let's assume you have perfect timing strategy, say not monthly, but let's say just calendar year. I know when S&P 500 will be up, and that's when I'm in the market. And then otherwise, if the market is down, I go into T-bills. That $1, instead of growing to $15,000, will grow to $2 million. So that's 16% annualized, right? That's a huge difference. So there's a lot of incentive in between that difference, right? So which is why I think that attempt to time the market or to time the premiums that we pursue will be never ending. That's a forecast I'm making here, but I think you will always see some of that attempts. Yeah.
So, what are some of the ways that investors do try to time the premiums?
Yeah, there are lots of different, things I see. I would say one of the most popular ones is using valuation ratios, because you probably often hear people talking about, oh, the U.S. market is being so expensive based on aggregate valuation. Is it now time to get out? Those type of statements you hear quite a lot.
Yep.
And also the same concept you can apply to any two sides of the premium, right? If you think about value versus growth, you can calculate the price book ratio of growth stocks relative to that of value stocks, right? And then you can look at basically then the difference is called the valuation spread. You can say, well, the spread is high. Maybe that's the time we want to switch to value. When the spread is low, it's time to switch back to growth. So that's definitely one popular signal I see. The other ones, I think people inevitably also look at past performance a lot. So I think there are definitely people who are betting on mean reversion. So essentially, if a premium has done really well, maybe then the premium will tank in the future. But then equally, there's also people betting on momentum, right? So if the premium has done really well, maybe then the momentum will continue. It's the time to continue to be in that premium or get into the premium. So definitely see kind of both sides of the spectrum. And I would also say that we do get a lot of questions from our clients in different kind of shape and forms, but a lot of them are actually timing questions in disguise, right? People ask you about interest rate, Fed actions, inflation, business cycles. Ultimately, I feel, everyone wants to know, right? If there's anything we can say about the future direction of the premiums or the magnitude of the premiums, and then, what that means for their asset allocation. So definitely lots of different methodologies that we see.
What kind of parameters need to be defined to implement one of those timing strategies?
Oh, yeah. So a lot of the concepts I was just referring to, they can be quite straightforward, right? But actually translating them into an actual strategy will involve a lot of parameter choices to a point, Ben. So essentially what you want to know is, when to go in and when to get out. And then let's use, say, valuation ratio as an example. People say, well, we should go in when it's cheap, when we should get out when it's expensive. But what is cheap? What is expensive, right? And then people say, well, then maybe you can look at the current valuation relative to the historical distribution. That's reasonable. But then how do you then construct a historical distribution, right? Do you look at the most recent 10 years or 20 years? Or do you look at all the data available to construct that, historical distribution? So basically an expanding window approach versus a rolling window approach. And then once you have that historical distribution, you still need to ask, what is the threshold, right, for being cheap versus expensive? Do you look at the 10th percentile or 20th percentile or maybe the median? And also, how often do you want to look at that signal and then to decide whether or not to rebalance? Is it monthly? Is it quarterly? Is it annual? So you can probably already get the sense that for every strategy, there's lots of parameters involved. And also the same strategy can be applied to, different premiums, different regions, which is why in our recent study, like most recent study on timing, we looked at 720. So that's a combination of three signals, so valuation spread, mean reversion, momentum. and 5 different kind of thresholds for switching in and out, 2 rebalancing frequency, annual versus monthly, and then also 2 kind of historical distribution, construction, you're using rolling versus expanding, 4 premiums, equity, size, value, profitability, and 3 regions, US, developed ex-US, emerging markets. Hopefully that's all. Yeah, if you multiply all of them, I hope you should get 720. That's what we did in our analysis. Yeah.
On behalf of all of the listeners, which timing strategies worked in your research?
Yes, that's actually typically what people are most interested in, right? Which ones work? And I'm happy to report that 30 out of those 720 worked. By kind of worked, I meant that they delivered reliable outperformance relative to kind of just staying invested, staying consistent focus on the premiums. And one of the best strategies we saw was a timing strategy that was used to time it's the market premium in developed ex-US market, and based on the valuation ratio that we were just talking about. And that strategy was able to actually avoid major market downturns in 2001, 2008, 2012 as well. So that led to a excess return on top of that average market return, let's call it 10%. So you get the excess return of 5.5 percentage points. So that's quite impressive. But there are definitely a lot of caveats. So what we also saw is that, yes, it's very easy to focus on the winner, right? But without asking, how much of that is actually due to luck versus skill.
Right.
And I often like to use that coin flipping analogy. If I ask you, Ben or Cameron, if I have, say, 10,000 people flipping coins, how many of them will flip 10 heads in a row? Any guesses?
Far more than I'd guess, I'm sure.
Yeah, our expectation there will be 10, right? So should then we then be calling them, say, coin flipping masters, and expect them to continue that performance? Probably not, right? So in terms of the best strategy I was referring to, it was used. It does rely a lot on that exact combination parameters. Annual frequency, rolling 10-year window, like a 10th percentile to switch out, 50th percentile to switch back in, and then we did some sensitivity analysis. We saw that if you just change one single parameter of that strategy, for example, change one of the percentiles you used, or maybe change the rebalancing frequency to annual to monthly, that alone would already reduce that excess return by more than half, and also make that excess return no longer reliable. And also the same strategy doesn't really work in other regions, or doesn't really work if you apply to other premiums. So I think just a good example showing that, yes, shining results can happen, but at the same time, they can be quite tenuous, especially if they are due to random chance.
Yeah, that's really interesting. So you can find a strategy that works, but it's super sensitive to like the region you tested it in, the parameters used to define it, and even the time period.
Yeah, absolutely.
Very interesting.
Yeah, in our paper, we definitely have another example showing how some of the results can be very, sensitive to time periods. I think it was related to, timing the US size premium using momentum. So essentially, right, betting the performance to continue. And a lot of that excess return is due to just 2 years. It was 1972 when size premium was down by a lot, 73 again down by a lot, like 90 to 20%. So of course, the momentum strategy worked, right, by avoiding that second negative year. But that alone contributed half of that excess return. And if you look at maybe the second half of the sample period without those years I was kind of describing, then none of the strategies would work. Yeah.
I guess the idea then being that it wouldn't be reasonable to expect that type of event to happen again in the future with that exact strategy.
Yeah, if your results are driven by, say, some outliers, right, just a very small part of the sample, then I think you do need to ask yourself how confident you are to kind of put your money into a strategy that has worked well in historical data, but actually very sensitive to those just a few outliers. Yeah.
I guess there are other trade-offs too, right? Like you'd introduce more turnover, probably more tracking error, all that kind of stuff.
Oh, that's right. Yeah, actually, in our analysis, we didn't even consider right tax considerations or your trading costs. Yes, so on top of that, it will be even less appealing to go with any of these timing strategies.